Hi everyone, Greg Martin, the Entrepreneur's Banker here. And a lot of times entrepreneurs are asked, what is the most stressful thing that you have to deal with, or what keeps you awake at night? And time again, I hear from a lot of entrepreneurs that payroll keeps them up at night. And so I asked him, okay, well, what's going on with that? He's like, well, sometimes it's Tuesday and I don't have enough cash in my account to make sure that all my guys and girls are going to get paid on Friday. So what you think of as payroll as being stressful is really working capital, or having enough cash in your business in order to fuel your business to actually achieve the growth and the goals and the operations that you have. So today we're going to accomplish three things. One, we're going to talk about what working capital actually is. Two, we're going to talk about the working capital cycle so that you understand how your business uses working capital. And then three, we're going to talk about the impacts that the management decisions that you make as the entrepreneur that impact your working capital cycle. Before we jump into all of that though, it would mean the world to me if you hit like or you shared this video. If you have not received the working capital workbook that I designed specifically to go with this course, that contains the notes and all the models that we're going to be talking about and using so that you can customize it for your business, send me an email at greg@theentrepreneurbanker.com and I'd be more than happy to send it to you. So I like to say that working capital is the fuel that the engine of your business uses to actually produce a good or service and then produce cash and net profit for you, the owner. A lot of times, capital or cash that's in the business is broken up into two things: working capital, which is the fuel, and then investment capital. And that is the capital that's used in order to invest into your business, into long-term assets for like buildings, big equipment, machinery, vehicles, stuff like that. As we start to look at and understand working capital, sometimes banks look at things a little bit differently than the way that entrepreneurs do. A bank traditionally looks at working capital as just the working capital that's needed in order to produce the good or service. Or from an accounting standpoint, it's the expenses that are included in your cost of goods sold. But a lot of entrepreneurs look at it from a modified working capital or an operational capital, and that includes the cost of actually paying your people and buying your inventory, but all the other operational costs, your rent, your utilities, your marketing, your insurance, all of those things that have to happen in order to run your business, but they're technically not tied into the cost of goods sold. So throughout our discussion and throughout this entire course, I'm going to talk about traditional working capital and then what I call modified working capital. I know that seems a little bit accounting, a little bit nerdy right now, but I promise you, as we walk through this course, it'll make a lot more sense. Okay, so what is working capital and how do I calculate it? Really easily, working capital is your current assets minus your current liabilities. Now, current assets typically include your cash, accounts receivable, and your inventory, or things that can be readily converted to cash pretty quickly. Your current liabilities, the biggest chunk of that is normally your accounts payable, or things that you have to pay within a very quick amount of time. So I'm going to give you two examples of two different companies, and so this will make a little bit more sense. But before I do that, I want to introduce one of the most important ratios that you need to understand when you are looking at and analyzing your working capital. And that is your current ratio, or that is the relationship between your current assets over your current liabilities. So is simply where you determine the amount of working capital you have is current assets minus current liabilities. Your current ratio is current assets divided by current liabilities. Now, it varies for different companies and different industries, but a good rule of thumb, a good place for you to kind of put as a goal is to have at least a 2.0 of your current asset or your current ratio, meaning that you've got twice as much current assets as you do current liabilities. And what that means is that you can actually use that extra current assets, those extra current assets that's over and above your current liabilities, to fuel your operations and to fuel whatever it is that you and your business do. Okay, So let's take a look at two companies. We've got strong corporation and bad corporation. So you can see here on this first balance sheet and income statement for strong corporation that this company has a total of $380,000 of current assets. And again, that's made up of cash, accounts receivable, and inventory. Now, they also owe people something. They owe their suppliers $75,000, or that's the accounts payable. So when we come over here and we look at their working capital that's actually in the business, it's $380,000 minus the $75,000, or $305,000. So think about it this way. So if they converted some of those receivables into cash and then they paid all of their accounts payable off, they would have $305,000 of cash, receivables, or inventory that is then the fuel for the company to be able to use as they're going and continuing operations. Now, their current ratio, again, the current ratio is the current assets over your current liabilities, or 5.1. That's well above the 2.0 threshold that we talked about before, or that's actually $230,000 above the 2.0. So this is a really strong corporation. So let's look at another corporation. Let's look at bad corporations. So you can see here, if you'll notice that the income statement is the same exact thing. So this is a company that is identical to strong corporation in every way, with the exception of the strength of their balance sheet. And you'll notice that the strengths of bad corporation's balance sheet, again, the current assets are made up of cash, accounts receivable, and inventories, is $180,000. But they owe a lot more in accounts payable. They owe $175,000 versus $75,000 with strong corporation. So when we look at what the working capital of this business is, it's 181 minus the 175, and that equals only $6,000. So they only have $6,000 after they pay all of their accounts payable off. They only have $6,000 in order to sustain operations. On a company that does $3.8 million in revenue, $6,000 isn't a whole heck of a lot. And you'll notice here that the the current ratio, again, the current assets over the current liabilities is 1.0. So they're $169,000 below where they should be when it comes to actually having the 2.0 for the current ratio. So now that we have a good understanding of what working capital is, let's talk about the working capital cycle. The working capital cycle is the cycle that your company goes through, and it starts with an order that is received from your customer. You then go and place material orders, or if you have inventory, you've got that. You receive the inventory or the material, and then you start the construction or the development of the good or service, or whatever your company does. After you are finished with the good or service, you actually deliver those to your customer and you issue them an invoice. And then if you offer any type of terms, then you get cash received from your customer either when you deliver it or at a later date. All of that's great, but for me, I'd like to have an actual example. So let's assume that Strong Corporation is a custom crate manufacturer. So if you've got to ship a dinosaur bone or something, or a jet engine that requires a custom crate, Strong Corporation is the company that you call. So a couple ground rules as we're going through this example. Let's assume that there's no other orders that are in production. This is the very first order that we've received. And then we're also going to assume that we don't have any inventory on hand. We have to order it, but our supplier is really, really good to us. We're best friends with the supplier, and we get the inventory the same day, and then they give us net 30, or they give us 30 days in order to pay for that inventory. Let's assume that it takes about 15 days in order to actually produce the specialty crate, and about a day to deliver it. And the day that we deliver it is the same day that our accounts receivable team is on it, and they invoice immediately. And then, because we really like the customer that we're working for, we're going to give them 30-day terms from the time that we deliver an invoice. And then finally, in order to make this really, really easy, we're going to assume that this company only has one employee, so we don't have to worry about paying other employees every week or anything else like that. Okay, so let's look at this from the eyes of Strong Corporation one more time, but looking at it through the lens of the working capital cycle. So on day 0, we are ecstatic. We've received the order from the customer. We immediately turn around and order the materials, and we get them the same day, and we start the production of the custom shipping container. It takes us 15 days in order to do the production, and then we turn around and deliver the container and invoice the customer immediately. We invoice them right away because we want to get paid. But we have to pay our supplier. Remember, we have terms from our supplier. Our supplier loves us, but they want to get paid 30 days from when they've received it. So we have cash that flows out actually on day 30. So that's cash going out of the business. But we had to turn around and we had to offer terms to our customer. And those customers were net 30 days. And so we won't actually receive cash from our customer until day 46 when cash flows into the company. It's easy to tell by looking at the working capital through this lens that there's an issue. And really, that's only taking one customer and one job at a time. But a lot of customers, a lot of entrepreneurs don't wait to service one company, one after another, after another, after another. You have lots of jobs going on all at the same time. So let's look at the working capital cycle in a little bit of a different model, in a circular model, in order to maybe understand and put a finer point on the working capital cycle. So let's take a look at that transaction one more time, but let's look at it from a circular perspective instead of just a linear perspective. So again, on day 0, we are ecstatic. We receive an order from our customer. We immediately order the materials and get the materials in, and we start production on the custom shipping container. Remember, it takes us 15 days in order to do that, but then we turn around and immediately deliver that container, and we want to get paid, so we send the invoice right away. So you'll notice here that we actually took materials on day 1, and then we converted those materials, that inventory, from inventory into accounts receivable. That's going to be important as we kind of talk a little bit in the future. So on day 16, it's converted into a receivable, but we have to pay our material supplier. Because remember, they gave us terms. They said that you don't have to pay for this stuff up front, but on day 30, I want my cash. So the cash actually flows out of the company on day 30. But we don't receive the money from our customer because we had to offer our customers terms until 30 days after we delivered. Well, we delivered on day 16, and then we are getting paid on day 45. So cash is actually flowing in on day 45. The time between the cash flowing out on day 30 and the cash flowing in on day 45 is known as your working capital need. Now, I want to talk about the 3 periods that we've got here, and these will come into play a little bit later, but we have the holding period, and that's the time where you actually hold on and you possess the inventory. We have the payment period, or the period that your inventory suppliers allow you to have that inventory but not pay them, but there'll come a time, in this instance on day 30, when they want to be paid. And then there's the collection period. That's when you have invoiced that customer of yours, and then you are waiting to collect that money from them. Identifying those 3 periods is a little bit of a preview for next week when we actually take a deep dive into each one of those periods and explain those in greater detail. So obviously, working capital is not a static thing because your business is not a static thing. You're constantly growing and you are taking on new jobs. You're meeting new customers and you're serving more people. You're making more profit. And also, you're having to make managerial decisions along the way. So understanding how working capital is impacted by growth and managerial decisions is super critical to this discussion. So, as an example, let's say that it takes $1,000 in order to produce one good or service for your company. Well, if you only have 10 customers, either at one given time or out throughout the entire year, then you only need $10,000 worth of inventory in order to actually meet those needs. But what happens if you grow and you're able to stay just as efficient and everything like that, and you go from 10 customers to 100 customers, to 1,000 customers, to 10,000 customers? Obviously, the growth impacts how much working capital you need to have, because it impacts how much inventory you're going to have to secure and actually execute on your job, whatever it is that you do. So that's just a real quick example of how growth impacts working capital. But what about managerial decisions? So let's assume that as you're going and you are getting larger customers, more lucrative contracts, and they're going to be able to provide not only top line revenue, but bottom line net income in order to help you grow, which is the point of a lot of corporations, that every corporation needs to make a profit. But let's assume that when you deal with these larger customers, you have to start offering longer terms. So if the example that we talked about, understanding that working capital need was based upon you having net 30-day terms and you giving net 30-day terms. But what if the larger customers that you deal with demand and say, the only way that you're going to get my business is if you give me net 90-day terms or net 120-day terms? Understanding how that stresses your working capital is a managerial decision that you need to make sure that you are prepared to deal with before you actually go and say yes to those types of contracts or to those new customers. Likewise, the same way a lot of suppliers and inventory companies, they give you discounts if you pay either as soon as you get delivery, or maybe like instead of taking all net 30-day terms, you pay net 10 and they'll give you a discount. Well, that sounds great. Discounts are always better because at the end of the day, that means that's dropped straight to your bottom line. But if you don't understand how your working capital is and your working capital cycle is impacted because you're having to pay 10 days instead of 30 days, then obviously your working capital need is going to increase even more. So again, it's not just growth that impacts your working capital cycle, and your working capital need, but it's also managerial decisions. And we're going to actually talk a little bit later. I'm going to give you a couple models that you can use in order to understand how specifically that impacts your business. Well, that's going to wrap it up for today. I hope that this brought immense value and it started to provide a little bit of insight into your business's working capital and working capital cycle. Over the next 3 weeks, we're going to actually further that insight by translating your working capital and actually quantifying the need that your business has into actual numbers, so that you can use that as you are planning on growing, as you're looking at expanding, or you're looking just to maintain operations, to make sure that you have got the staying power, or you have your business engine has the fuel that it needs in order to produce all that it does. Again, if you haven't done so, please hit like on this video. It means the world to me that this brings value to you. Please share it with any entrepreneur that you think that we get a lot of value out of it. And if you have not received the Working Capital Workbook, that again includes the notes and all these models that we've talked about, then please send me an email at greg@theentrepreneursbanker.com and let me know how I can send that to you so that we can work together. Until next week, this is Greg Martin, the Entrepreneur's Banker, wishing you success, wishing you peace, and wishing you an amazing week.